used by over 65,000 businesses, particularly in North America and in Europe and the UK and Ireland, and also Australia and New Zealand. So welcome, thank you for coming. I'm Anthony Pollock. A little bit about me. I'm a chartered accountant by profession, and I've been doing it for quite a while. And I bought into the Value Builder system last year in order to combine my CFO services with the Value Builder exit planning package, which I think is it's a tried and tested system and plays to both our strengths. I myself have built and run my own business during the period 1989 to 2004 before selling it. I have been involved in management buyout as CFO, raised money and been responsible for basically putting in place all of the back office services, including finding offices and carpets and computers and everything. And I have also been involved in a business subsequently where I was and also fundraised, and I exited that company after raising 3 million, and the company now has over 24 million in turnover. So a lot of experience of building businesses, advising people, raising money, building value. And I believe with the Value Builder exit planning system, that brings together two very valuable and worthwhile services. Built to Sell is been developed by a Canadian called John Warillo, who wrote the book Built to Sell as a result of building and selling various businesses, and then having his mate say, well, give me some advice. Can you help me with this? Can you help me with that? And the Built to Sell was published in 2010. Since then, question, does it work? I believe it does, but the proof of the pudding seems to be that in up to, 2018, 34,000 businesses had used it, and people who scored well on the assessment got nearly double the value of their business than those who did not. And not only did they get more in value, they got more offers, and therefore were able presumably to choose the best offer for them. And I think that should you wish to engage, we will be able to do something similar for you. I think one of the key aspects to sell your business, or to think about what on earth you're going to do after you sold the business. I was talking with a lawyer a few years ago who told me the story of a very nice niche company making a niche product for the aircraft industry up in Cambridge. And the owner woke up on his 65th birthday, decided to sell the business, and got a terrible value because everybody knew he was going to sell. So nobody had an incentive to offer him a good deal. And my lawyer friend said it was an ideal management buyout opportunity, but he didn't do that. He sold it and walked away with a lot less money. So thinking about in it. The other bit is that, surprisingly, or maybe not, a lot of business owners, when they sell, aren't happy. They seem to think they'll be happy, or I presume they think they'll be happy when they plan to sell, but actually the statistics seem to say that they're not. So the Value Builder system particularly has a module around thinking through what you plan to do. And so that when you do sell the business and you do get the money and you do shut the door on the office for the last time, you're actually going to go off and do something you want to do, something you've prepared for, and something that you can be happy at doing. And so the key aspects here are future vision. What are you going to do? Having some flexibility, a degree of personal detachment, I think, which has surprised me, but I think that's important, and involving your team. That is assuming that you have a team, but if you don't, maybe that's one of the things that needs to be built in order to sell. So those are the key pieces, and I'm going to just quickly go through an exit checklist of those issues to think about when you're planning to sell. So Is your business ready to sell? Do you own a business or do you own a job, as the E-Myth writer says? And I think important piece, the value builder assessment tools, there are 3 of them, one of which is geared to understanding if your business is ready. The other piece is connected to the exit planning bit, which we're just talking about. So you need to get clear on why you're exiting. There are things that are pushing you to exit, such as the market, health, boredom, stress, retirement, possibly even family. And there are things that are pulling you to exit, such as you want something else you want to do, might be the new business, fancy travel, spending more time with the family. But it's important to understand these. The other aspect, I think, is really, really vital is timescale. Going back to my example of the businessman deciding at 65 he was going to sell. This is from one of the value builder assessment tools for somebody I worked with last year. She wanted to retire at 60. We were in 2022 at the time. It assumes a 3-year earnout, though I think there's part of the process, I think, is actually working out how to minimize that, largely because if you've been running a business for 20 or 30 years, you may not actually enjoy working for somebody else. When I sold my accountancy practice in 2004 and went from making all the decisions and being in charge to suddenly not being consulted, and I hated it. So I think that trying to minimize this earnout period is quite important. My cousin's husband, who exited a business last year, I think they had an earnout of just over a year. 18 months is probably something that is a good thing to aim for. Again, this timescale assumes it takes a year to sell the business. It may actually take a bit longer than that, depending how easy it is to find whoever it is who wants to acquire it. But don't underestimate the due diligence process and the lawyer's process and the discussions around price and the earnout terms. So that in this case left 4 years of actually getting the business ready to sell. I'm currently dealing with another business, and I think I've got 4 or 5 years. They want to retire by the time they're 30. So we've got about 5 years to complete the process. So exit timer, really, really important. The other aspect of exit options, you can sell outright, you can recapitalize and get back into the game and push on towards a higher goal. If you really are, had enough, you could liquidate it. Some businesses maybe need to be liquidated rather than sold, but that's a separate question. And if that was your plan, then there are decisions that would be made to maximize the liquidatable value. You may wish to change your role. If I was talking with a business recently, the CEO is an obvious techie, he's interested in R&D, and probably in the long run is not the right person to be CEO. So there's a potential of actually making the choice to shift into a different area of the business from the operations standpoint, or perhaps to step up to being chairman of the board and to have a strategic overview rather than a day-to-day involvement. Some people, though, it seems to be less common these days, wants to transfer the business to their children or the next generation. Again, if that's a plan, then there's issues around preparing the children to be in a position to take over. And finally, as I talked about earlier, the opportunity of a management buyout. If you have a team of people who are 20 years younger than you, then they may be hungry enough to buy the business and to take it forward. And therefore, it is important to align your reasons to sell with your various exit options and therefore your exit plans. So for this section, do write down what you are wanting to go and do, in the Value Builder system, there's a pre-score questionnaire which would help you with that process. The next piece of this presentation is around how much do you need? It's very easy for people to say, oh, I just go and sell and then I live off the balance. But if you actually want to be financially free, then you need to have an idea of how much you actually need. The Value Builder system assumes something like 32, 33 times your current pre-tax income, which if in this example, if we say it's 100,000, then you need 3.3 million. But then you have a look at other assets. You might have pension funds, savings, properties that you don't live in, that would ought to come into the equation. You may have some debt, which therefore has net assets outside of the business, which you obviously is deducted from the amount of money that you need. So in this instance, it's 2.6 million. And then if you've got some long-term business debt, you get to 2.8. And then, of course, you've got all your sales proceeds and sales costs, and the taxman wants a chunk. 20% might actually be a bit low these days, particularly as capital gains tax is 28, but then entrepreneurs relief, I think, is still at 10. But depending on the chancellor at the time, you may have more or less in the way of tax. In this example, you would sell your business 0.8 million. The issue then would be, is your business actually worth that? And we'll come on to that in a few minutes. So suggestion here is that you complete the Freedom Point questionnaire, which will help you with assessing your Freedom Point. Now, moving on to the core of the Value Builder system itself, we have a questionnaire. It's called the Value Builder questionnaire. It consists of 100 questions over the following areas. So the reasons for the set of questionnaires, so yes, is the more you score, the more saleable your business is. If you score 90 plus, then you'll get much better offers. In this case, 7.1 times net profit or pre-tax profit, compared to 3.5 if you only score about 50 odd. And obviously, if you're scoring in the 30s and 40s, then much lower, you would be offered much less. John Warrillow in his book has identified 8 key drivers of value. There are some others, but the most important are these 8 key drivers that he's discovered, I suppose, over a number of years. So having looked, and the key piece here is looking at the business through from the buyer's perspective. A lot of business owners are the business is the apple of their eye. If it's something they've created, it must have good value. But perhaps a buyer might not see it in the same way. And the 8 drivers of value enable the seller of the business to start to understand how a buyer would view it, and therefore how to put it in the best position for the buyer to value it highly. Out of those 8 drivers, some will be glaringly obvious in need of being addressed quickly because they drag the value down substantially. And then after that, there would be other areas which could be improved to provide a premium value, premium offer. And the Value Builder process works between the initial engagement through to the sale of the business. So, and it is assumed that you will need at least 2 years of financial accounts that have been improved following the Value Builder process, so that you will have the foundations for the buyer to business and assess and agree to the values that you require. So This is an example of how the value builder score impacts the value that you get for your business. So if you are scoring less than 50, you will only get sort of just under 2.5 times net profit. And if you get a score of 80, you're getting nearly 6. And these are obviously on average. The latest numbers I've got from Value Builder, they've worked with 65,000 businesses since 2012, and they value the current financial performance. The Switzerland structure is your dependency on staff, customers, and suppliers. And do you have any one of those that is overcritical to the business? Because that on its own will reduce the value you get. The seesaw is connected to, does the business consume cash or does it throw off cash? If you have a business, a lot of professional services businesses have, a minimum of a month in work in progress and a minimum of a month or so in debtors. So it can be effectively 2 to 3 months between doing some work and getting paid, and that's if you're doing well. And what that means is every time you increase turnover, you're putting 2 to 3 times that amount into your cash requirements to run the business, your working capital. The other one here, recurring revenue. The more recurring revenue you have, the more valuable the business is. Monopoly control is the extent to which you have something that differentiates you from your competitors, that another business would consider to be valuable, because then you can charge premium prices and generate more cash. Customer satisfaction is connected to the ability of your operating your business and the people within your business generating additional revenue, which you haven't gone out and done marketing or sales activity on. So it's a sort of passive growth. And the hub and spoke piece is how much of the business goes across your desk. How dependent is the company on you to make all the decisions? And if the more that the company is, you have to make every single decision and be asked and talked to about anything and everything that occurs, the less valuable the business is to somebody else, because all the period that you have to undertake within the acquired new structure. So let's just briefly go through the key 8 drivers. So financial performance. This is an example of a business turning over of a million pre-tax profit per annum, with an assumption of a discount of or a return of 15% a year, and that would create a net present value of 5 million over the next 10 years. So you might be offered 5 million for it. If you had a business that the 8 drivers of value were created some concerns and created a sense that there was more risk to the business, a buyer might want a bit more of a discount over the 15%. And then in this example of a 50% discount, your 5 million has gone down to just under 2 million, and potentially the business would be valued somewhere between the two of them. If correspondingly there's a demonstration that the pre-tax profit is going to rise over the next 10 years, then obviously that will affect the annual value and will significantly increase the net present value at the end of 10 years. And again, the value builder system would seek to provide a basis for those assumptions. Some examples of some people who've sold businesses through the value builder process. Tom Farici sold his business for 4 times EBITDA. This is Jill. She sold her £11 million company for 38.8 million. Rod here sold his £2 million company for 15. That was a good deal. David here sold his company for 10 times profit. And this Stephanie, I think, is a really interesting example. She built a company up that undertook payroll for people who had to employ a nanny to look after their children. And so people had, one nanny, and they needed someone to run payroll, and she ran payroll for a whole load of wealthy individuals and families who needed a nanny. And when she came to sell her business, she found somebody who already had a business where they could effectively cross-sell her services. And she said to them, if you persuade 10% of your customers to buy my service, you have a 70-odd million pound business overnight. And so she got 54 million for her business. And this is an example of the sort of the synergy, the looking for the right buyer, for trying to have something that has got a value to somebody else, where it improves the value of their business as well, and sort of 1 + 2 = 10 rather than 3. And again, I think in the value builder process, one of the aspects of looking at who might buy your business, looking for these opportunities is quite crucial. The second driver is growth potential, and this is the principle that John talks about. Is instead of selling lots of things to a smaller number of people, you sell one thing to lots of customers. Now, most of us have a number of services, and so it's not as simple as that, but reducing the complexity of the business, and perhaps even separating out into separate divisions, which may in themselves actually have different buyers, might be a way around this particular issue. But this is an area that the more that the business can be, and it's this piece here. If the business is teachable, valuable, repeatable, then it's easier to train members of staff to deliver the product or deliver the service well and efficiently. That more profit and more customers that are happy recommending your business, which then improves the top line and the bottom line and the value. The Switzerland structure is connected to, as I said earlier, this issue of being able to switch suppliers, not having concentrations of revenue, because if you have a 50 or 60% of your business made up by one customer, and you sell the business, if I'm buying your business, then I'm very concerned that I might lose that customer. In accountancy practices, onto the customer for at least a year. If you lose a year, then you don't pay for them. So this important piece here is to make sure that your customer base is broad. And then finally, the piece around employees, is not being over reliant on any one employee, so that if they left, you have serious problems, or they could take a lot of the clients with them. This is I talked earlier about working capital. If you need cash to grow the business all the time, then you have a situation that the buyer will probably take that amount of money away from the amount he would be paying you. So if you have a business that potentially is worth 10 million, but they need 3 million in working capital, you may only get 7. So the objective of the value builder process is to try and work on the business so that it generates cash rather than consumes it. Recurring revenue. This is obviously the SaaS business, in the sense that many of you will know about, or just recurring services that people acquire. And this is an example of how recurring revenue actually is beneficial to the value of a business. So the two businesses, one makes installations every year, and therefore those installations are one-off, needs to go out and find new installations all the time, and therefore is worth less than a business that has effectively recurring revenue that it it is able to automate and to customize the delivery of the services in a way that are easier to repeat and more valuable to a buyer. So here we can see that somebody with over 50% of recurring revenue gets more more often wanting to buy the business than a business that, and you also find that you have a higher multiple on average. So trying to structure the business and trying to have a business that has more recurring revenue is valuable. And accountancy firms, legal firms, certainly accountancy firms, and I suppose IFAs have a lot more recurring revenue and therefore a lot more valuable. Monopoly control is this area of market differentiation leading to better pricing, higher margins, and more profit, which means there's more money for marketing, which can be then used to improve the turnover and profitability of the business. And as you can see here, that if you have some degree of monopoly or some degree of differentiation in the UK and Ireland, that you will get an average of 6 times multiple against an industry average of under 4. Customer satisfaction is, again, one of those sort of passive marketing aspects that are often underlooked. The Net Promoter Score is people who are promoting you, less people who are saying very nice things about you, which gives, in this case, a Net Promoter Score of 20. In the wider market, Apple has a Net Promoter Score of 47, Samsung 57, and Sony 61, with an industry average of 44. This is in consumer brand area. So it'll obviously be different in smaller companies, but the more that you have a happy and satisfied client base or customer base who are recommending you to their friends and associates, you will get more business and you will spend less money on the sales and marketing process. Hub and spoke is it's fundamentally where too much sits around you. So you have to sell everything, you offer too many things, you deliver too much, and you have to deal with all of the customers. And so, again, to some extent, you own a job rather than a business. When you're not there, business slows. When something goes wrong, they come to you, and at some point, you get to your capacity to deal with everything, and so the revenue gets to a plateaued position. And similarly, if everything comes to you, the opportunity to get a good price for the business is reduced. And so if you have a business that is structured in a way that you could be absent for a period of time and the business would still thrive, you will get more of an offer and a better offer as a result. So again, we have the 8 key drivers of value: financial performance, growth potential, the Switzerland structure, which is the fact that you don't have too many dependencies between, you're not over-reliant on a single customer, supplier, or member of staff. Your company generates cash rather than consumes it. You have recurring revenue, which means you can concentrate. You don't have to do so much sales and marketing. You've got some sort of monopoly or some sort of differentiation in the market. Your customers are happy, and there is a structure whereby everything doesn't go across your desk and enables you to have a bit better work-life balance. There is a Value Builder report, which is based on the questions that you about your business, that has a overall score, and then a score for each of the 8 areas, and then there is a piece around each of the areas and how potentially to improve those areas. We say here a score between 50 and 80 means that you have opportunities to significantly improve the value of your company. According to the Value Builder analysis of thousands of businesses, you could improve the value of your company by up to 7.1 times by increasing your score to 90 or higher. So we have here some examples of the return on investment, which if you start off 3.5, you would have a value of 2.8 million. If you, with the same profit and a Value Builder score of 90, means you would have a business worth 5.6 million, an increase of nearly 3 million. This is dollars, but it would work for pounds as well. And this is based on analyzing more than 55,000 businesses. So how do you, what do you do? There are 3 Value Builder questionnaires covering your sort of retired, how much money you need, and the status of your business. My recommendation would be that you seek to complete those questionnaires, and you book a assessment time with me to go through them, and then following that you engage in the Value Builder engagement program, which is a monthly cycle of going through each of these 12 modules. So it works on a monthly basis, and it would run for at least 2 years, so that we go around these modules at least twice. There's opportunities to focus on those that are more urgent, but it covers each of the eight areas, 8 drivers of value, but it also includes working out who your ideal buyer might be and your best and most appropriate opportunity to sell. So these are the next steps: taking the score and scheduling an assessment. And you can book a follow-up 15-minute webinar to have a general discussion with me at this address. There are a couple of boxes in there which you can fill in whether you are keen to jump in straight away. We want more time to think about it, but my recommendation is that you arrange a Zoom call to follow up this webinar. Thank you. Gosh. So yeah, I suppose questions.
Yeah, everyone is free to unmute himself and do any question.
No questions? Did I cover everything thoroughly to your satisfaction, or was there anything that you felt you would like to know more about?
I do have a question. First of all, thank you for the presentation. It was really insightful. I see that the presentation was recorded. Will you also be able to share the recording with us so that we can review it afterwards?
Yes, we
Yes.
will be able to do that.
That's great. Thank you.
Anyone else? Everyone stunned silence. Well, what we have arranged is that we will follow up with a phone call because we'd like your feedback on what you thought, whether you're interested in taking anything further. If we've missed anything and you think afterwards, I would like to have known that, it would be useful to know that. If you're interested in looking at selling your business, I do urge you to book some time. And I particularly, it's this issue of waking up tomorrow and deciding you want to sell is a bit late. If you think you might sell in the next 5 years, let's start the process, because I think it's the way you're going to maximize the value. And the other piece that I think is valuable in this is if you need 5 million to retire and your business is only worth 2, and if after doing the value builder process it's only worth 3, then that's where my CFO services come in, which is, okay, how do we get your business to the value that you need it to be, using, maybe, do you have to buy something? What are the other pieces that are part of the equation? By the time they're 30, and we're working on, okay, what's the target? What's the growth target? What's the reporting? And so using all the sort of CFO services that I offer to sit alongside the value builder services to help achieving that objective. And we will, I have no doubt about it. Oh, hang on. It's all right. There's something in the chat.
No answer.
Nothing of
Yes,
any. Nothing of any.
Just to thank regarding the presentation. They want a copy of it that we are going to send to all of them.
Oh, we will send you so that you can review those, and we'll send you the recording as well. Well, I booked an hour for this, and I seem to have managed to get through it in 40 minutes. So thank you for your time today. Thank you for attending. Really appreciate that. And look forward to speaking to you soon.
Thank you, Anthony.